Welcome to the Three Edge Week in Review for the week of June 17th. I'm Fritz Foltz, the Chief Investment Strategist here at Three Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. Today, Steve and I will be discussing what we all seem to be experiencing, and that is a stock market bubble or a market melt up. And we'll talk about two competing emotions, two competing fears that investors may be feeling. One is referred to as FOMO, or the fear of missing out. It's simply investor anxiety, thinking that they are not participating enough in the stock market rally, which began last fall. The other competing emotion is the fear of losing money in the market. The anxiety from the fear that the market has run up so far since October of 2023, that a market decline must be right around the corner. And both of these emotions, both of these fears are quite real. And so we thought it might be helpful if we address these fears in today's video to see if we can help investors to strike a balance between these two competing emotions. So now, let me bring Steve into the conversation, and let's talk about these two conflicting emotions that pose challenges for investors. And Steve, maybe to begin, could you just describe what actually is happening when a market is in market melt-up mode? What's going on? And second, might we be able to learn anything from market history in terms of market melt-ups from the past?
Well, Fritz, when I think of a market melt-up, I think of how stock market gains lead to further gains. It's a self-reinforcing feedback loop or a virtuous cycle that feeds on itself. And what's interesting is Warren Buffett had a comment about stock market investor psychology, how it's completely inverse or backwards from consumer psychology. If you go into a supermarket, you tend to look for bargains or sales, and you want to buy more of those things that are on sale at lower prices and buy less of what's at a higher price. And yet stock market investors seem to be backwards to that, where the higher the market goes up, the more they want to buy in. And also about market melt-ups, it's often said that it's not till after the stock market bubble crashed that people can look back with hindsight and say, oh, it was obvious it was a stock market bubble, that we were all in. Those are all the signs. Usually people figure it out after it's too late. Now, in terms of learning from history, one thing we've learned from history is that people don't learn from history. And we can look at human behavior of stock market investors and their emotions and how they keep repeating the same patterns over and over through history. We say right now we're in a stock market bubble or a market melt-up that's based on the narrative around AI. And in particular, there's one stock, NVIDIA, which is performing spectacularly well and growing exponentially in price, and has captured the imagination and helped lift the entire S&P 500 index because it's become a bigger and bigger part of the index, that and a few other AI stocks. And yet we've seen in the past similar situations. We just have to go back to the 1990s and the tech stock bubble that ended in March of 2000. And there, the NVIDIA of its day was Cisco. And we had tremendous excitement and enthusiasm about the internet and how someday the internet was going to be a major technology. And that was proven true. But the enthusiasm around the internet got way ahead of the fundamentals. Stocks soared and then crashed, and tech stocks fell from peak to trough 80%, over 80% before they recovered. Further back, in the roaring 1920s, we had great technology innovation at that time. We had electricity, we had automobiles, we had radio, we had mass production. In the NVIDIA of its day was RCA, Radio Corporation of America, and its stock went soaring higher and captured everyone's imagination like today, lifted the entire market, only to crash, and U.S. stocks fell over 80% from peak to trough. In the 1870s, we had the technology of its day, railroads, which is a brand new thing, taking over the country. And the NVIDIA of its day was Union Pacific Railroad, and its stock soared in value, went up exponentially, and helped drag the whole market up with it. And then the stock market bubble burst, and stocks crashed over 50% after that. And then going all the way back to 1720, we had the famous South Sea bubble, which perhaps some people feel was the biggest stock market bubble of all. And the South Sea Company had the technology of its day, which was to have ships that could go to South America, extract natural resources, and bring them back to Europe. And that captured everyone's imagination, lifted the entire stock market to soaring heights, only to crash and fall over 90%. So those are some lessons from history.
All right. So the title of the video today is The Fear of Missing Out versus the Fear of Losing Money. So how should investors think about these two choices? How does one balance these two very real, very powerful emotions?
Well, an important part of investing that a lot of people don't talk about is actually managing fear. And as you point out, there are two types of fear. The fear of missing out and the fear of losing money. And everyone has a unique risk profile, and people vary along the spectrum of risk seeking to risk minimizing. But history shows that when the market is rallying, people often lose sight of their original goals, and the fear of missing out becomes more and more prominent. And people forget about that the stock market can go down. And then conversely, when the market is correcting or crashing, people forget about their long-term investing goals and how they want to stay invested over the long term to make a decent return. And they're very focused on the fear of losing money, become very short-term oriented, and often panic and sell at the bottom. And the data shows that because of these fears, that most people buy at the very top of a market, and most people sell at the very bottom of the market. And when I say that people don't learn from history, it's because it keeps repeating over and over and over again. So the key is trying to manage these two fears, which can be emotionally very difficult, and most people get it exactly wrong.
Here we go then with my final question, and that is, okay, but what is it that investors can actually do? What can they do? Should they just be fully invested in U.S. equities, including NVIDIA for now? And then when they start to see the market correct, well, they just get out. They just sell and get out of the way and avoid the major downturn. I mean, it sounds like a reasonable approach, but it also sounds pretty dangerous. So what would we suggest investors actually do in this case?
Well, Fritz, it does sound so easy. Why not stay fully invested and ride it all the way to the top, get out at the peak, and count your winnings? Of course, that's what every investor group has tried to do through all these historical stock market bubbles, and yet there are stories one after the other of how many people lost all their savings and all their money in the ensuing downturn. So why is it so hard to stay fully invested and then get out at the peak? Well, number one, as they say, no one rings a bell at the top. So it's hard to know when you're at the top. And during a rally, investors get conditioned that because markets don't always move in a straight line, there are these dips that they were rewarded over and over again from buying the dip. And so the first time the dip is real in the beginning of a correction, it just seems like every other dip that we're paid to buy. So there's a lot of reluctance to want to sell on that first dip. And then after the dip, the market starts to rebound again, and that gives investors hope that it's just another short-term dip and that the bull market is still on. And with that hope, it's easy to stay fully invested and to ignore the warning signs that maybe the correction is here. And then after that rally, there's another dip, and it might be even worse. And then the fear starts setting in, the fear of losing money. But right before that fear gets too great, there's another interim rally, and there's hope that, well, maybe the correction is over, and it's a good thing we didn't sell, and the market starts to go up again, and a relief that someone did so. And then the next correction goes even lower, and by the time the fear of missing out dissipates and the fear of losing money builds up, you're a lot closer to the bottom at that time. And then clients or investors often say, I don't care what the price is, get me out. I've had enough of the stock market. And that's why people tend to sell most at the bottom. So these emotions do take over. And there's a famous saying that's built up over time because this keeps repeating, that bear markets slide down a river of hope. And so that's something that's very important to know. So what we think the key is to try really hard to separate the emotions from a much more objective reasoning. And we find a lot of solace in the fact that we have a model that looks at different factors. We look at valuation, we look at economic factors, we look at behavioral factors to try to guide when does it make sense to participate, when does it make sense to be more cautious. And right now, if we look at the U.S. market, and we look at what our model is saying, on the valuation side, which are long-term factors, it's saying the market is highly overvalued, on a par with the tech stock bubble of 1990s, on a par with the roaring 1920s. And therefore, one should be very worried long-term that we are in a bubble. On the other hand, the economic factors are quite mixed, and the investor behavioral factors are still highly positive. And
Right.
what we know about bubbles is they can persist a lot longer than what logic might suggest. So it does make some sense to continue some participation in this market. This could still continue some time longer. And depending on an individual's risk tolerance, we have 3 different strategies that are all diversified, but at different levels of risk. For those that have more fear of losing money, we have our conservative strategy, which has done a fantastic job minimizing downside risk and minimizing drawdowns, and yet making a modest but decent return on the upside. On the other side of the spectrum, we have a growth strategy. In our growth strategy, it has quite a bit more participation in the market. Right now, about 75% is invested in equities. And for those that have a stronger fear of missing out, but some fear of losing money, this is a strategy that we can adjust over time. When all of our factors turn negative, we can reduce that equity exposure. And then in the middle, we have our total return strategy, which is more balanced between the fear of missing out and the fear of losing money. And currently, it has a little less than 50% equity allocation. So there's a place for different risk preferences along a spectrum. So what we think is that one should consider that they don't have to be all in the market or all out of the market, because then if you're all in the market, the fear of losing money could take over. If you're all out of the market, the fear of missing out could take over. Have a balanced approach that makes sense for you.
Excellent. Great. Thank you. Thank you for your insight into what certainly does feel like a market melt-up at the moment, and also just for providing some guidance in terms of how investors might approach the current environment. So that will do it for Steve and me for this week. We'll be back next week with another edition of the 3Edge Weekend Review. And as a reminder, all our videos are always available on our 3Edge YouTube channel. You can go to YouTube, type in 3Edge, and you'll find our full library of videos there. And if you know someone who you think might enjoy or benefit from these videos, please feel free to share them. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.